What if I told you the biggest risk in the stock market right now isn't a crash? It's the quiet, dangerous belief that crashes don't matter anymore. Because think about what most investors have experienced over the past decade. Every dip has been a buying opportunity. Every panic has been temporary. Every headline that screamed, "This time is different," ended up being wrong. And slowly, without even realizing it, people stopped fearing risk. They started expecting rescue. That's where things get interesting. Because markets don't just move based on data. They move based on behavior. And right now, behavior is built on confidence that hasn't truly been tested in a prolonged, uncomfortable environment. It's easy to say you're a long-term investor when your portfolio recovers in weeks or months. It's easy to believe in staying the course when the course has been consistently upward. But what happens when that pattern breaks? Not necessarily with a dramatic crash, but with something far more frustrating. A market that goes nowhere. A market that moves up and down repeatedly with no clear direction. A market that slowly chips away at your patience instead of your capital all at once. That's the kind of environment most people are completely unprepared for. Because the real challenge isn't watching your portfolio drop 20% in a week. The real challenge is watching it do nothing meaningful for years while inflation quietly erodes your purchasing power. The real challenge is staying disciplined when your strategy stops feeling like it's working. And that's where the unthinkable begins to unfold. People start questioning everything. They start jumping between strategies. One moment they're long-term investors, the next they're trying to time the market. They sell out of frustration, then buy back in out of fear of missing out. And ironically, this constant switching, this lack of consistency, does more damage than any market downturn ever could. Because here's the uncomfortable truth. Most investors don't lose money because the market is against them. They lose money because their behavior changes at the worst possible times. And that behavior is shaped by expectations. Right now, expectations are built on a relatively short period of market history where resilience was rewarded quickly. But markets don't owe us that pattern. They don't have to recover on our timeline. They don't have to validate our strategies when we want them to. So the real risk isn't that something dramatic happens overnight. It's that something subtle happens over time, and most people don't recognize it until it's already affected their decisions. Because when your beliefs about the market are challenged, you don't just adjust your portfolio. You adjust your behavior. And that shift, quiet, emotional, and often irrational, is where the biggest losses actually begin. Let's be honest, most people feel confident about investing not because they've deeply analyzed their decisions, but because things have worked out so far. That's a very different kind of confidence. It's not built on understanding, it's built on experience in a favorable environment. And that creates an illusion. Because when you buy something and it goes up, your brain doesn't question the decision. It reinforces it. It tells you this works. But it rarely asks, why does this work? Or more importantly, when might this stop working? That's the gap most investors operate in. They own index funds, they hold a handful of popular stocks, maybe a few names they've seen online or heard about from friends. And on the surface, it feels diversified. It feels logical. It feels safe. But if you look one layer deeper, many of those investments are driven by the same underlying forces: liquidity, low interest rates, strong consumer spending, and consistent earnings growth. So the question isn't just what you own, it's what conditions your investments depend on. Because every strategy has assumptions built into it. And most people never take the time to identify those assumptions. They just inherit them. For example, the idea that markets will always recover quickly, that central banks will step in when things get bad, that large companies will continue to dominate and grow. These beliefs aren't random. They've been reinforced by recent history. But they're still assumptions, not guarantees. And the problem with assumptions is that they only feel invisible until they're challenged. When the environment changes, even slightly, those assumptions start to crack. Maybe interest rates stay higher for longer than expected. Maybe borrowing becomes more expensive, slowing down growth. Maybe consumer behavior shifts. Suddenly, the same assets that felt stable begin to behave differently, not dramatically at first, just enough to create doubt. And that's where the illusion of safety starts to fade. Because safety isn't just about what you own, it's about how well you understand the risks attached to it. If you don't know why something works, you won't know when it stops working. And if you don't know when it stops working, your decisions become reactive instead of intentional. You start relying on headlines. You start watching prices more closely. You start making adjustments based on short-term movements instead of long-term reasoning. And ironically, the more uncertain you feel, the more likely you are to make decisions that increase risk rather than reduce it. That's the paradox. What feels safe on the surface can actually be fragile underneath. Not because the assets themselves are bad, but because the understanding behind them is shallow. Real safety in investing doesn't come from picking the right assets. It comes from knowing how those assets behave across different conditions and being mentally prepared for those shifts. But that level of clarity takes effort. It requires asking uncomfortable questions. It requires accepting that even good strategies can go through long periods of underperformance, and most people avoid that discomfort. They prefer the simplicity of believing that what worked before will continue to work. They prefer the reassurance of seeing others do the same thing. They prefer the feeling of safety, even if it's based on incomplete information, until the moment that feeling disappears. Because when the market stops aligning with your expectations, it doesn't just challenge your portfolio, it challenges your confidence. And if that confidence wasn't built on understanding in the first place, it becomes very difficult to hold on to. Right now, the biggest shift isn't loud. It's not a dramatic headline or a sudden collapse that forces everyone to pay attention. It's quiet, gradual, almost easy to ignore. And that's exactly why it's so powerful. Because markets don't need to crash to reset expectations. They just need to stop behaving the way people are used to. For a long time, investing felt relatively straightforward. You put money into the market, stayed consistent, and over time, you were rewarded. Even if there were short-term dips, the recovery was quick enough to reinforce the idea that patience alone was the strategy. But what if patience on its own is no longer enough? What if the environment shifts just enough that returns become slower, less predictable, and more uneven? That's the kind of change most people don't price in. Not because it's unlikely, but because it's uncomfortable. It challenges the simplicity that people have grown used to. It introduces friction into a system that felt smooth, and friction changes behavior. In a lower return environment, the same actions don't produce the same results. You might still be investing regularly, still following the same plan, but the feedback loop changes. Progress feels slower. Gains feel harder to come by. Losses feel more frequent, even if they're not larger. And psychologically, that matters. Because investing isn't just about outcomes. It's about how those outcomes make you feel along the way. When results are strong and consistent, discipline feels easy. When results are mixed and uncertain, discipline starts to feel like doubt. You begin to question whether your strategy is actually working or whether you've just been relying on favorable conditions. And that's where many investors start to drift. They look for alternatives. They search for something that feels more effective, more responsive, more in control. Maybe that means trading more frequently. Maybe it means chasing sectors that are currently outperforming. Maybe it means abandoning a long-term plan in favor of something that promises quicker results. But this shift, this move away from consistency, is exactly what the environment is testing. Because a more complex market doesn't reward impulsive decisions. It exposes them. When volatility increases and returns become uneven, timing becomes harder, not easier. Reacting to short-term movements often leads to entering at the wrong moments and exiting at the worst ones. And over time, those small missteps compound. Not dramatically, but consistently. And that's what makes this environment so challenging. It doesn't create obvious mistakes. It creates subtle ones, repeated over time, that gradually pull results down. At the same time, the absence of strong upward momentum makes it harder to rely on the market to fix those mistakes. In a high-growth environment, even poor decisions can be masked by overall gains. In a slower market, those decisions become visible. There's nowhere to hide. And that's the shift that isn't being fully acknowledged. It's not about predicting a downturn or expecting a rally. It's about recognizing that the conditions themselves may be different from what people have built their expectations around. A market where skill matters more than optimism, where patience needs to be paired with awareness, where doing nothing is sometimes the right move, but only if it's intentional, not passive. Because the biggest change isn't in the numbers. It's in what those numbers demand from you. And for many investors, that demand is unfamiliar. Here's the part that doesn't get talked about enough. Because it doesn't sound exciting and it doesn't sell well, but it's where the real advantage is built. When the environment becomes more difficult, more uncertain, and less rewarding on the surface, most people instinctively look for ways to regain control. They try to optimize, react faster, find better opportunities, or avoid losses entirely. But the edge doesn't come from doing more. It comes from doing fewer things, better, because when expectations reset, the game changes. The easy wins disappear. The margin for error shrinks. And suddenly, the difference between thoughtful decisions and emotional ones becomes much more visible. This is where disciplined investors quietly separate themselves, not by predicting what the market will do next, but by preparing for multiple outcomes. They stop relying on a single narrative. They accept that markets can move in ways that feel irrational in the short term. And instead of fighting that, they build strategies that can handle it. They think in terms of probabilities, not certainties. That means understanding that even good investments can underperform for extended periods. It means recognizing that holding cash isn't always a failure. It can be a form of flexibility. It means being selective, not because opportunities don't exist, but because not every opportunity is worth taking. And perhaps most importantly, it means separating activity from progress. Because one of the biggest traps in a slower, more volatile market is the urge to constantly adjust, to feel like you need to be doing something at all times. But constant movement doesn't guarantee better outcomes. In fact, it often introduces more noise, more mistakes, and more second guessing. Progress in this kind of environment is quieter. It looks like sticking to a plan when it's not immediately rewarding. It looks like resisting trends that don't align with your strategy. It looks like making decisions based on logic, even when emotion is pushing you in a different direction. And that's not easy, because the feedback you get from the market won't always reinforce those choices right away. Sometimes it will feel like you're missing out. Sometimes it will feel like you're being too cautious. Sometimes it will feel like nothing is working. But that's exactly why it works. Because most people won't maintain that level of consistency. Most people will drift, react, and eventually abandon their approach in search of something that feels better in the moment. And that's where the opportunity comes from, not from the market itself, but from how people behave within it. When others are chasing clarity, disciplined investors are managing uncertainty. When others are reacting to short-term signals, they're focused on long-term positioning. When others are trying to be right all the time, they're focused on being resilient over time. That shift in mindset doesn't eliminate risk. It changes how you deal with it. Instead of trying to avoid every downturn, you build the capacity to absorb them. Instead of trying to maximize every gain, you focus on sustaining progress. Instead of needing constant validation, you rely on a framework that holds up even when conditions don't. And over time, that approach compounds. Not in a dramatic overnight way, but steadily, quietly, and with far less dependence on things going perfectly. Because in a market where the obvious strategies become less effective, the real advantage isn't in finding something new. It's in executing the fundamentals with a level of clarity and discipline that most people underestimate.